All right, let's talk now about how credit scores are calculated. Now, this video may have a little bit of the same verbiage as another video, but we're going to dive a little bit deeper into these calculations and what companies are looking for, all right? So many people are surprised to find out that they don't have just one credit score. Credit scores will vary for several different reasons, including the company providing the score, the data on which the score is based, and the method of calculating the score. Credit scores provided by the three major credit bureaus, which are Equifax, Experian, and TransUnion, may also vary because not all lenders and creditors report information to all three credit bureaus. While many do, others may report to two or one or none at all. In addition, the credit scoring models among the three major credit bureaus are different, as well as those used by other companies that provide credit scores, such as FICO or Vantage Score. The types of credit scores used by lenders and creditors may vary based on their industry. For example, like I said before, if you're buying a car, an auto lender may use a credit score that places more emphasis on the payment history when it comes to auto loans. In addition, lenders may also use a blended credit score from the three major credit bureaus. In general, here are some of the factors considered in credit scoring calculations. Depending on the scoring model used, the weight each factor carries as far as impacting a credit score may vary. So let's look at these. Let's consider first the number of accounts you have, or the type of accounts you have, your used credit versus your available credit, the length of your credit history, or your payment history. All right, so here is a general breakdown of the factors credit scoring models consider. Keeping in mind there are many different credit scoring models. All right, so let's start out. Payment history. When a lender or creditor looks at your credit report, a key question that they're trying to answer is, if I extend this person credit, will they pay me back on time? One of the things that they will take into consideration is your payment history. How have you repaid your credit in the past? Your payment history may include credit cards, retail department store accounts, installment loans, auto loans, student loans, finance company accounts, home equity loans, and mortgage loans. Payment history will also show a lender or creditor details on late or missed payments, bankruptcies, and collection information. Credit scoring models generally look at how late your payments were, how much was owed, and how recently and how often you missed a payment. Your credit history will also detail how many of your credit accounts have been delinquent in relation to all of your accounts on file. So if you have 10 credit accounts and you've had a late payment on 5 of those accounts, that ratio may impact credit scores. Your payment history also includes details on bankruptcies, foreclosures, wage attachments, and any accounts that may have been reported to collection agencies. Generally speaking, credit scoring models will consider all of this information, which is why the payment history section may have a big impact on determining some credit scores. Now let's talk about used credit versus available credit. Another factor lenders and creditors are looking at is how much of your available credit or the credit limit you're using. Lenders and creditors like to see that you are responsibly able to use credit and pay it off regularly. If you have a mix of credit accounts that are maxed out or at their limit, that may impact credit scores. Think about it this way. When you go and apply for a Home Depot credit card because they just offered you 10% off and you're buying, let's say, $2,000 worth of stuff, and you're like, I'll do it, it's $200 off. And then at the same time, you go down the street to Macy's and they offer you an account because, hey, your wife or maybe your husband wants to buy a bunch of clothes. And you see what I'm saying? You sign up for the Home Depot, then the Macy's, and so on and so forth, and they're small accounts, but you're maxing them all out. That's what they're referring to. All right, now let's move on to type of credit used. Credit score calculations may also consider the different types of credit accounts you have, including revolving debt, such as credit cards, and installment loans, such as mortgages, home equity loans, auto loans, student loans, and personal loans. Another factor is how many of each type of account you have. Lenders and creditors like to see you're able to manage multiple accounts of different types, and credit scoring models may reflect this. Now, let's also jump into new credit. Credit score calculations may also consider how many new credit accounts you have opened recently. New accounts may impact the length of your credit history. What about the length of credit history? Well, this section of your credit history details how long different credit accounts have been active. Credit score calculations may consider both how long your oldest and most recent accounts have been open. Generally speaking, creditors like to see that you have a history of responsibly paying off your credit accounts. Now let's dive into hard inquiries. Hard inquiries occur when lenders and creditors check your credit in response to a credit application. A large number of hard inquiries can impact your credit score. However, if you are shopping for a new auto or mortgage loan or a new utility provider, the multiple inquiries are generally counted as one inquiry for a given period of time. That period of time may vary depending on the credit scoring model, but it's typically between 14 and 45 days. I've said this before, a lot of people get freaked out, let's say when they're shopping for a car, and they only have so much time in a given day. So they go down and look at, let's say, a Toyota, and the Toyota dealer convinces them, hey, let's pull your credit and see what kind of deal we can get. And they do it, and you're like, I don't really like what you're offering me, right? Based off your credit. Then the next day you go look at a different car and you pull that. A lot of people are freaked out by doing that, but when it's done within that 14-day period for sure, and going from 14 to 45, I wouldn't stretch it out too much, but within 14 days, the credit companies understand that you're actually actively looking for a new vehicle. Okay, so they're not going to ding you like if you were to go and look for a Home Depot credit card one day, 5 days later, go look for a new car. Then 6 days after that, you're going to look for a mortgage, okay? These credit score calculations do not consider requests a creditor has made for your credit report for a pre-approved credit offer. So that's important too. When you get a pre-approval credit card offer in the mail, they're not considering requests to hit your credit, okay? Or periodic reviews of your credit report by lenders and creditors you have an existing account with. Checking your own credit also doesn't affect your credit scores. These are known as soft inquiries, and we're going to talk about that later and why it's important for you to monitor your credit situation. Look, in summary, the point being is there's so many different things that affect your credit, but take this into account. At the very end, you checking your credit is not going to hurt it. And that's what we want to work on. We want you constantly seeing that number, and we want to watch that number go higher, which means you are saving money for any future loans that you take out. All right, with that being said, let's move on to the next lesson.